In early 2024, UnitedHealthcare stock was at an all-time high, but out of nowhere, the CEO was assassinated in broad daylight. But just a few months later, the DOJ launched an investigation into UNH's Medicare billing practices. Investors panicked, and in just 4 months, the $500 billion company crashed 60%. But then came a bombshell. Warren Buffett disclosed a $1.6 billion stake in UnitedHealthcare. If the world's most legendary investor is buying, should you buy too? I'm Sidma, and today I'll break down why UnitedHealthcare could be one of the best healthcare investments of the next decade. So, let's start at the beginning. What exactly is UnitedHealthcare, and why are they such a big deal? Well, UnitedHealthcare is the largest health insurance company in the US. They cover over 50 million people. That's about 1 in every 7 Americans. Their customers range from individuals to massive corporations. But here's what makes them stand out. UnitedHealthcare isn't just an insurance company. They run through 2 huge divisions. First, the UnitedHealthcare side. This is the traditional insurance you'd expect. Health, dental, vision, plus government programs like Medicare and Medicaid. If you've ever had employee-provided insurance, there's a good chance it came from them. Then there's Optum, and this is where things really get interesting. Optum has 3 main parts. Optum Health, which directly provides care through clinics, urgent care, and telehealth. Optum Rx, which manages over 1.5 billion prescriptions a year, and Optum Insight, which powers hospital and clinics with data, IT systems, and analytics. So when you put it all together, UnitedHealthcare doesn't just insure you. They also provide you care, handle your prescriptions, and even run the software behind hospitals. That kind of integration locks people into their system, creates multiple revenue streams, and makes it almost impossible for competitors to keep up. And that's exactly why they've been so profitable. Now, let's talk numbers, because at the end of the day, investing is all about fundamentals. In 2024, UnitedHealthcare generated over $400 billion in revenue. To put that into perspective, that's more than the annual GDP of countries like Norway, Ireland, or South Africa. Out of that revenue, they booked $22 billion in profit, which was almost a 12% increase from the year before. But here's where it gets really interesting. Because of all the scandals, their market cap has fallen to just $275 billion. This means investors are valuing them at a huge discount compared to what they were worth just a year ago. And then there's a PEG ratio, or the price to earnings growth ratio. UnitedHealthcare's PEG is about 0.8. What does that mean? In simple terms, if the company grows just as fast as analysts expect, the stock is still undervalued. Most good companies trade at PEGs above 1, so anything above that usually signals Wall Street is discounting the company too harshly. So why might they be wrong? That's where UnitedHealthcare's hidden advantage comes in. The biggest edge UnitedHealthcare has is Optum. Optum Health serves over 110 million people directly through doctors, clinics, and care services. Optum Rx processes 1.5 billion prescriptions per year, making it one of the most important players in the US pharmaceutical supply chain. Optum Insight sells data, analytics, and software that help hospitals cut costs and improve outcomes. It's a sticky business with high margins, and once hospitals adopt their systems, switching is almost impossible. This combination gives UnitedHealthcare recurring revenue, high margins, and an unbeatable competitive moat. Most insurers just sell coverage. UnitedHealthcare owns the coverage and the infrastructure underneath it. Now, let's put together a conservative price target. Analysts project 2025 revenue of $445 billion. If revenue grows at 10% annually for the next 7 years, that would bring them to $870 billion in revenue by 2032. If margins stay at 6%, that's about $52 billion in profit per year. Apply a 20x earnings multiple, which is standard for the healthcare sector, and you get a company worth about $1 trillion. Compare that to today's $275 billion valuation, and the upside is staggering. Even if growth slows or margins compress, there's still a massive gap between where the stock trades today and where it could go long term. Of course, no investment is without risks. Let's go over the 3 main ones, from least worrying to most worrying. First, regulatory risk. Healthcare is one of the most heavily regulated industries in the US. All it takes is one new law from Congress or new rules from Medicare, and UNH's business model could get squeezed. That said, they spend millions every year on lobbying, which historically has protected them from the harshest regulatory changes. Next, reputation risk. UnitedHealthcare is already under fire after the CEO's assassination and the DOJ's probe. Public perception matters in healthcare, and if the company gets branded as greedy or unethical, it could lose customers and face more government scrutiny. And last, and most importantly, execution risk. This is the most important one. UnitedHealthcare has to carefully manage how it grows. If they raise premiums too aggressively, customers may leave for cheaper insurers. If they expand too quickly, costs could spiral out of control. They need to balance growth, customer retention, and regulatory compliance all at the same time, and that's not easy. But if you believe in United Healthcare's track record, their ability to grow consistently over the last decade, and are comfortable investing in a company that some critics call monopolistic or exploitative, United Healthcare could be one of the most compelling long-term plays in the healthcare sector. If you found this deep dive helpful, make sure to like the video, subscribe to the channel, and let me know in the comments what company you would want me to break down next.